Hello traders, and in this video we're going to talk about invalidation points. Now, to start off with, the first invalidation point that you guys will probably be aware of is the fact that we have our structure points, right? Obviously, if price goes into break structure, it invalidates this range, okay? It invalidates our trading range, and therefore we stop looking at we stop looking to go long in this situation. Obviously, the only situation where we will sort of not ignore structure, but anyway, that the situation that where we won't consider structure break as a change in trend is when we have our impulsive OB that's been left unmitigated, and we have our SROB, which is here, and then price can sometimes violate the SROB and react off the impulsive OB. That's the only time that the invalidation point doesn't make sense. So at this point, in terms of our structure, our invalidation point is going to be below the impulsive OB, which is why that after every time we miss the two rules. So say, for example, we've got rule one, rule two, and say if it goes on to break structure again, this is why we reset, and now this becomes rule one, and this becomes rule two. Alternatively, going to a higher time frame, which is what the ideal situation would be, you'd have to follow where your two rules are at that point. Now, that's the main reason why we follow it. So with this being said, we do have our main important validation being under the impulsive OB at that given time frame, at that given point. The other point of validation that we have, sorry, it's quicker me doing this, isn't it? There you go. The other point of validation that we have is the mitigation point. So when we have this, we have the OB that's here. Okay, that's been mitigated, and then you broke structure again. Invalidation point now lies below this mitigation. So say that this candle wick or whatever it is mitigated this OB, invalidation now lies below here. Okay, that's our invalidation point. The reason being is because this has been mitigated in terms of order flow, it doesn't make sense for price to come crashing down. It can, however, obviously grab liquidity and continue. However, we can't anticipate that, and that's not something that we can prepare for. However, in terms of being safe and understanding where your stop loss should be, and ideally, it's by following the mitigation and understanding where the last mitigation has taken place, and that's where your invalidation point is for order flow. So we have our structure order flow, not sorry, we have our structure invalidation point, and we have the order flow invalidation. There's not one that's better than the other, or there's not one that's more important than the other. They're both fair. They both are important, but understanding both of them is key. Now, order flow is more so giving you the idea of where to safely put your stop loss, whereas structure is telling you the direction, and it will invalidate the direction that you're looking at if obviously it breaks structure. So, say for example, I'll use clean lines now. Say for example, we'll look at a bullish scenario where we have this situation. Okay, so in terms of structure at this point, our invalidation point is going to be our trading range is now here, but also we have the impulsive OB that is here. Okay, so technically our invalidation point for this trading range is here, and the invalidation point for the whole thing for going long is going to be here. Okay, below the impulsive OB, which is why if you're going to take a trade, to be conservative and if you want to focus on win rate, say if you're going to take a trade off the SROB, your stop loss to be safe should be below the impulsive OB. Alternatively, obviously you can use, if you follow the course, you can just simply place two trades and split your risk. It's up to you at that point. Now, that's for your structure and validation point. Now, to understand your invalidation point for order flow, we need to realize that order flow is mitigation. Okay, that's all it is. So, say for example, we have this mitigation point. So this SROB has mitigated the impulsive OB. Now, our point of validation for structure at this point will still be it'll still be below the SR OB and the impulsive OB. But for an added confluence of where your stop loss should be, if you think about where the last mitigation was, our last mitigation was here. So our technically our invalidation point should be just below the last mitigation, because in terms of order flow is mitigation. So if this was to continue as healthy order flow, price should in theory come back, mitigate this, the OB that caused the last mitigation, and then continue higher. And then that's what we expect as healthy order flow. Obviously, price doesn't move as cleanly as that, and we all understand that, but we need to understand where our points of validation are in terms of order flow in this situation. I think the invalidation point in terms of order flow, it makes more sense. And this is the reason why I always say use the extremes, because generally the extreme is where the last mitigation occurred. So you guys have most likely, well, you guys have been using this subconsciously without realizing why we use the extremes. And hopefully this video give you a bit more of a idea as to where, why your stop loss should be where it is, and why you should trade it with confidence, because you are trading with your stop loss above or below the points of invalidation. So let me get rid of this and we can look at a chart together. Let me get rid of that. So I've got GJ at the minute. There we go. So I'm not going to talk about the structure point at this point. I'm just going to talk about what's actually going on here and where safely we can understand to put our stop losses and where the last invalidation points occurred. Now, what we can see is obviously, let me turn off the, sorry, there we go. So what we can safely see in this situation is obviously we've got a breaker structure. Okay, breaker structure. Now, here, we can take a trade off this, obviously from here. Now, this mitigated that something here, okay, mitigated the OB. So the last point of mitigation, oh no, there. The last point of mitigation was that wick there. So if we're going to trade, say, off this OB, say we refine this, our point of validation is just going to be above that last mitigation. Why? Because if price was to violate that mitigation, then order flow is transitioning to become bullish at this point, because this mitigation indicates that there is going to be bearish order flow, right? So then what happens? We create the structural low. This is on a lower time frame mitigation. I don't know why that's marked. I don't really need that there, but what we can understand is, so now we create this structural low. The last mitigation point was here. So the point of validation technically is here. Ah, okay, that's why. So the reason why this made sense is because on the hourly time frame, sorry, on the hourly time frame, it doesn't make sense for price to go even further, because whatever's happened here has all been mitigated by this. So anything on the lower time frame has been mitigated. That's my thinking behind it. However, again, if you still want to be safe, you can still keep that as your higher time frame point of validation. But in terms of what makes sense and what's clear, you need to understand that the last mitigation point happened from here. So in terms of pricing efficiency, you need to think that the point pricing is pretty efficient along here, and the inefficiency comes from this drive here, and we see the obviously clear inefficiency here. So what we need to think about at this point is we are safely following order flow, and if you're just going to take risk entries on the higher time frame, you can just place your stop loss above here, above there. And now if that goes into break structure, the last mitigation point is here, so having a stop loss above here is going to be working out. It would work out better for you in terms of improving your win rate. Now that we have this mitigation here, if we zoom into this, sorry, if we zoom into that and we go to the 15-minute time frame, let me play this out just a little bit. So what we need to think about from the last point of mitigation, so we have a mitigation point here, and then this went on to break structure, okay? Now, what we can technically say is that this has left a little bit of imbalance, but in terms of the whole buy to sell, it has pretty much been mitigated by this move here, okay? But ideally your point of validation is still going to be above the overall mitigation point. You can't, because for the reason being, when you have this situation here, we don't know if it's actually mitigated something or not unless you actually investigate it. But for me, when I was looking through it, it didn't really mitigate something that was significant. If it touched this wick, which it didn't, if it did, then we can safely say our point of validation is here. And if you place a trade from this OB itself, we can take that safely. Okay. But then obviously what we can see is obviously we have rule one, rule two. So now this rules off this one, and we have these two at this point. And it also tied in, and if you watch the GJ breakdown, you'll know that this POI tied in to, where is it then? It tied into, well then. Bear with me, I don't know why it's taking so long. Oh, there you go. So if we go to the 30-minute, the 15-minute POI, it tied into the fact that we have this 30-minute breaker structure here, and this OB has been mitigated by this wick. So our point of validation would be the last mitigation here, which makes sense now. If we go to the 15-minute time frame, this POI now makes complete sense as to why that's a strong point of reaction to look for. Now, when we're following this, so obviously if you're using it, you could take a trade off this safely now that you understand where your stop loss should be. Again, if you want to be safer, if you want to be more conservative, obviously place your stop loss above that higher time frame mitigation. Now that we're going into this point, this is when we can start looking at how points of validation make sense as to where you place your stop loss. So in this sense, what we can see here is we have this breaker structure. We have this breaker structure here. Okay, this OB has been mitigated by this wick, and then we create this low. Now, because of that mitigation play that's happening, we can actually investigate what's actually going on inside there. Now, this is a fairly complex situation, but the idea is the same, right? What we can think about here, oops, what we can see is, so this trade, again, I would hope that you've watched the trade breakdown to this. So what we can see is that we have that's the 1 minute breaker structure that's happening here. Now within this we have this OB that's just been mitigated. Now we can investigate what's actually going on inside there by looking at the lower time frame. So what we can see here in this situation is we have a mitigation play here. Okay, you know what? I'll use this. We have um, a mitigation point here, and then we have a breaker structure, and continue. Where the last point of mitigation point was here, the pricing is pretty efficient. So because what we can see here is that there's no imbalance, it's all been filled at that point. The only point of imbalance that created this whole move that broke this structure is here. Okay, obviously we've got these POIs sitting, these OBs sitting here, but in terms of the extreme and understanding where the last point of invalidation would be, if you think about that, that's my stop loss was above here, was this high purely because the last point of validation was here, which means if you think about what's actually happening in terms of an OB can either grab liquidity, it can mitigate something, and you generally get a nice volume candle, right? Now, in this situation, this OB mitigated that. So there could still be something that's not been mitigated within this 5 second candle. Obviously, I'm not going to look any lower. That's just ridiculous. But there's still going to be something in there, which is why we need to understand that our invalidation point is going to be above that our stop loss, sorry, is going to be above the last mitigation. That, therefore, is our invalidation point because we are assuming that there's OBs in that that have mitigated this previous OB that caused the previous mitigation. So now that we understand that, we can safely place our stop loss here. Obviously, if I wanted an aggressive approach, um, let me get rid of that. If we wanted an aggressive approach, obviously I could have placed my stop loss just above, so including spread. So what's that? Including spread. So if I include like a pip, I could have done an aggressive stop loss, but obviously conservatively, placing it above the invalidation point makes sense. That is based on the assumption that there's something still lying within this. Okay, and to be honest, that was a 3 pip stop. So for me, I didn't sacrifice too much of a I didn't sacrifice too much of my risk to reward in that sense. So if you want to go aggressive, place your stop loss above the OB. But if you want to be a bit more conservative and you want to focus on win rate, then have a look at where your points of validation are and then place your stop loss above them or below them to make sense. Now, another way that you can use and your points of validation, let's look at EG. EG has been moving really well. So what we can see in this situation here, um, sorry, okay. So we can see that we have this mitigation play here. Okay. Now, to understand if this reaction makes sense, we want to see if it's actually mitigated anything, okay? And if we go to the hourly, again, I hope that you've seen the breakdown for this video, for EG itself. Let me get rid of this. So what we can see is, let's follow this reaction. So this wick, there we go, has mitigated something here. Now let's see what is mitigated. So it's mitigated the liquidity wick that caused that whole impulsive move down. So does this reaction, well, does this mitigation make sense? Yes, it does, which means that we can actually start looking for the trades because we know that mitigation now actually makes sense and it's valid to start looking for trades, okay? So in this point, let me go to the 15-minute time frame. Let's stretch this out. So the last mitigation point was there. So our point of invalidation is here, okay? And we are going on the assumption that the reaction would make sense purely because it's mitigated something that is significant, okay? It makes sense what it's mitigating. So the reaction play now would make sense. What we can see now is a breaker structure, okay? That's rule number one. Okay, now in this case, what we can look for is where pricing is efficient or inefficient, and what we can see is pricing is efficient until we get this little move here. Pricing is inefficient here. So we can assume that this wick has mitigated anything that's previous from here, okay, on the lower time frames at this point. So we can assume that this is now our point of validation because we're assuming that this has mitigated whatever was here that caused this move down, okay? Because obviously this is somewhat in the middle of a move, but with a wick that large, you can assume that it's mitigated something before creating this move down. However, that's based on assumption. However, this mitigation is fact. So having your point of mitigation here, it makes sense. And what you can do in this situation to be safe is have your entry point here. Let me get rid of that and place your stop loss obviously above here. That's a huge stop loss to be fair, but to be safe, your stop loss ideally above that point of validation. Your aggressive point would be above here. Okay, but what we can see is this now has been mitigated. Okay, so our point of invalidation now lies above here. Okay, because that's the last point of mitigation because it just makes sense that this has to be mitigated. So price shouldn't, in theory, go any higher than that. Obviously it could, but wouldn't really make sense to us. Then what we can see, sorry, then what we can see is that we have the next breaker structure here. Now, we can assume that this huge wick, and obviously that's a liquidity wick, has mitigated anything that's previous. Because what we can see, the only point of invalidation, not invalidation, sorry, the only point of imbalance that we can see is this small little area here. It's not, yeah, this very small area. I was going to say it's not very large, but I just said the same thing. Now, we can assume that wick has mitigated this, so our aggressive point of invalidation will be above here. But in terms of the overall invalidation, that makes sense is this point here. because this is not clear what is mitigated. And to be fair, that's not even an OB, that's really broken structure, unless we can say that that's broke minor structure on a lower time frame and it's just been mitigated. However, um, to be a bit more conservative, understanding what's clear to you, for me personally, that is a better mitigation point and that's a better point of invalidation for me. But obviously, I took a different entry point here. So my entry point was obviously based off, if you, and I'm sure you've probably seen it, my entry point was based off this 1 minute OB. That's there. So I went for an aggressive stop loss, which I usually do anyway. Unless the point of invalidation, to be fair, it's not a conscious effort that I look for the invalidation point, purely because I just follow the two rules that make sense. Because you have to realize that the two rules and everything that I'm explaining in the intuition phase is uh, encompassed within the two rules itself. So although I'm explaining all this, it's not something that I actively look for. It's just something that just naturally happens if you're following the two rules not aggressively, if you're following the two rules religiously. So for me, having my stop loss above here and including spread, it makes sense. And obviously that was just a liquidity grab, which I couldn't have anticipated. So somewhat, I am somewhat lucky to be in this trade at the moment. Um, so to recap, your point of validation is essentially the last mitigation points that make sense to you. So it has to make sense to you, and it just overall has to make sense as to what it's mitigating. Because for me, the reason why, and this is a key part, is this is obviously a react. If you look in the 4 hour, right, we've still got space for price to go, especially on the daily. Like this daily POI is huge. However, the reason why we can trade off this reaction is because is mitigate something that makes sense. It's mitigating an OB, okay, that causes whole moves down. So we can study the reaction from here. So our point of mitigate invalidation is above that mitigation. And then once we study the reaction, we can follow the mitigation play and understand what is going on from here. Okay, so that was two examples that I've just shown you. So on GJ is another one. Another thing is if you follow EG, right, what we can see is, and this is just on the 4 hour, what we can see is obviously we've got our that breaking structure. Yeah, so we've got a structure break here, okay, and what we can see is from here, pricing is pretty efficient until it comes to this point here, this candle. Okay, now we create this low that goes on to break obviously this structure, and it's obviously broke this structure as well. That structure is not really relevant because we only need that first break. Pricing is efficient, and on having a reaction point here, it would make sense because we can assume that this wick has mitigated something previously from here, and you can look for the lower time frame to see if it has mitigated something, because I believe it did. If you follow the 1 hour, I think it did. Yeah. What we can see is if you're following the 1 hour, because the 1 hour structure's point is here. So from here, in terms of minor structure, what we can see is we can see break of structure, okay, low mitigation, break of structure that happened here. So the point of mitigation was here, but in terms of pricing and efficiency, we can see that this has somewhat been mitigated if there was a lower time frame um, break of structure here on a minor scale. Our point of mitigation, again, our point of validation and mitigation in this case would obviously be the last mitigation point, which we can assume is going to be this wick that mitigates something here. If you go to the 4 hour, it's a bit more clean to follow. Let me get rid of all these. There we go. So what we can see in this situation, we have mitigation here. So this makes sense, okay? Now we have this mitigation which goes on to break this structure here. That's the last point of that's the last mitigation point, okay? And this is a good example actually to show you is obviously that's our clear OB, which is what we had highlighted, but the point of validation is obviously above this wick because we can assume there's still something there inside this wick that needs to be mitigated, right? And that's exactly what's happened. So now That's mitigated that. Our last point of validation is now above this mitigation point. So studying the reaction after this, it makes sense. So now we have this break instruction. Obviously, we have this somewhat liquidity wick and another break. But in terms of our invalidation point, and where the mitigation happened is going to be this point of action for this POI here, which is what I labeled, and that's where price is reacted from, and look where it's gone. Okay, so to be safe, it makes sense. So this is why we need to think about, because in terms of the two rules in a lower time frame, this is our hourly breaker structure. So we have rule one, rule two on the hourly situation, but using the extreme makes more sense because that's the last point of mitigation. So generally, price can react off the successful retrace. Yes, as we can see, we have a somewhat reaction, but you need to think if it makes sense or not to you. Now, if you're going to wait for the extremes like I do most of the time or majority of the time, you do have the risk of price reacting at the SR and then going. You just need to accept that because for me, win rate is everything, and I'd rather be in a winning trade, obviously, than a losing trade, and I want to be in the highest probability trade that I can be in. So using the extreme forces you to follow the last mitigation naturally anyway. But now you understand why I'm saying use the extremes, because now it should make sense as to why your stop loss should be where it is and understanding what invalidates your order flow as well as what invalidates your structure. So I hope this video gives you an insight as to how to follow order flow, how to why you place your stop loss where to put it, and how to be a bit more conservative. Should you wish, you can be aggressive or conservative. That choice is yours. It's not for me to decide for you. But now you have the option, and now you have the understanding as to which one you prefer to choose. But for now, I'll leave you guys be, and I hope this video has cleared up questions about invalidation.